One of the things the Fed is looking at right now is that there has been a deceleration in economic growth. There has been a deceleration in job creation, and that's what they're focused on. By the way, neither one of those is bad, right? The economy is growing. There are more jobs being created. There are 8 million unfilled jobs out there right now, but they are looking at rate of change and the direction of change.
On Wealth Track, what does a major reversal of Fed policy tell us about the economy, jobs, and the markets?
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. In the journalism business, the news is your friend. It gives us something to talk about and report on. In the investment business, that is not always the case. News is change, it's not always positive, and it can represent unpredictability. How you interpret it and respond to it can mean the difference between investment success and failure. Our guest this week was considered to be one of the best interpreters of events and their investment implications during her distinguished Wall Street career, and she hasn't lost a beat. We are delighted to welcome her back for the first of a two-part interview. She is none other than Abby Joseph Cohen, now a professor at Columbia Business School. Joseph Cohen retired from Goldman Sachs in 2021 after a 3-decade-plus career during which she was a partner filling multiple leadership roles, including as president of its Global Markets Institute and its headline-making chief U.S. investment strategist when she was ranked #1 by Institutional Investor. She has consistently been named one of the most influential thought leaders in the financial services industry by Barron's, Fortune, and other publications, and is a regular member of Barron's annual roundtable and one of its 100 most influential women in U.S. finance. Our focus this week is the U.S. economy and markets, and we do indeed have major news to discuss. The Federal Reserve recently changed course for the first time since March of 2022, when it embarked upon the fastest and most dramatic series of interest rate hikes since the 1980s. It raised the federal funds rate 525 basis points. That's 5.25 percentage points in rapid succession. At its most recent meeting, however, the Fed cut its short-term policy rate by a hefty 50 basis points and signaled there were more rate cuts to come. It's worth repeating what Fed Chair Jerome Powell said in announcing the cut. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. Well, I asked Cohen, who started her career as an economist at the Federal Reserve, how confident she was in the Fed's policy change.
I think the Fed made the right decision, Consuelo. First of all, they made the decision to begin to lower interest rates, which was correct. And in order to send the right message to the markets and others, they did 50 basis points rather than 25. And I think that's entirely appropriate, given a few things. First of all, inflation is under much better control than it was, #1. #2, they are looking at the pace of economic growth and the pace of job creation, both of which are still good but have decelerated. And #3, they're trying to send a message basically telling everyone that they're on the case, they're watching the data, and they'll do whatever is needed.
Has inflation been licked? Is mission accomplished?
Inflation has, in fact, been largely licked and has been for the last few months. That doesn't mean, however, that people are happy with the level of prices. You know, at the beginning of the pandemic, we saw an upward step in prices at the grocery store, in housing, and so on. Inflation, which is the rate of change of price increases, has slowed dramatically. At one point, it was as much as 8 or 9%. It's now down to about 2 to 2.5%. But we still have prices at the grocery store that make people uncomfortable. And a lot of the prices that the average family sees, the middle-income family sees on a regular basis, The stuff that they buy each week or pay for every month, those are the prices that haven't come down. It's very hard to envision a situation where prices actually do go down. That would require not a disinflation, that is, a reduction in the rate of inflation. It would require deflation of the sort that we had during the Great Depression in the 1930s. That's not likely to happen.
Abby, you were one of the few economists that I know about at any rate who, when the Fed started raising interest rates in March of 2022, that you said that you did not think there would be a recession. What gave you that confidence, and what's your outlook now?
In 2022, the Fed moved correctly because inflation was high and rising at that time. But I didn't think there would be a recession for several reasons. Number one, the consumer sector was robust. The household financial picture, the balance sheets, and so on were looking good, and consumers were showing that they were willing to spend money. In addition, the U.S. corporate sector was in good shape, and corporations were doing a lot of CapEx, that is, capital expenditures. They were showing they had confidence in the future. And, of course, the Fed didn't want there to be a recession. I felt that this was a Fed that would raise interest rates, but would be ever vigilant to make sure that the economy didn't slow too much.
You started your career at the Federal Reserve in Washington, D.C. Does the Fed have that much power? Can they really decide, no, we're not going to have a recession, or yes, we're going to have a recovery? Are they that powerful now?
I was a junior economist, and I learned a great deal. And one of the things I learned is that monetary policy is just one piece of the puzzle. The Federal Reserve has control over the Fed funds rate, not necessarily the level of interest rates throughout the capital market structure. So the Fed looks at what they can do. They're also monitoring what's happening in fiscal policy and so on. And one of the things that I am concerned about, and this is a long-term concern, has to do with the following. We have an economy which has been growing, and we have a deficit which has been growing. Normally, when the economy is doing well, corporate profits are rising, personal incomes are rising, the budget deficit gets smaller. Ours has not. It's been getting somewhat larger, and that's something that will require some policy attention.
Where is that being reflected in the markets, in the financial markets?
Right now, I'm not sure it is being properly reflected. We have seen a sigh of relief in the bond market with interest rates having come down, bond prices having risen. But at some point, the rubber hits the road, and we're going to have to, as a nation, try to figure out what we're going to do to keep that deficit from continuing to rise. And by the way, there's the annual deficit, there's the aggregate long-term debt, and that's something that we have to pay down. With this decline that we've been seeing in interest rates, of course, it becomes less expensive for the Treasury to finance that debt that we have already incurred.
Is that part of the Fed's thinking?
I think that the Fed is focusing on its dual mandate. Right. The dual mandate is inflation, which is now largely under control, not totally, but they're also looking at the labor markets. That's what they are instructed to be concerned about. And one of the things the Fed is looking at right now is that there has been a deceleration in economic growth. There has been a deceleration in job creation, and that's what they're focused on. By the way, neither one of those is bad, right? The economy is growing.
Right.
There are more jobs being created. There are 8 million unfilled jobs out there right now. But they are looking at rate of change and the direction of change. And I think they are appropriately focused on what is not necessarily happening right now, but as Wayne Gretzky would say, where the puck is going to be, and they want to be prepared for that.
So where is the Fed funds puck going? The Fed has signaled that there are going to be some more interest rate cuts. What do you think?
Clearly, this is a Fed that is very data dependent. They're making their decisions based upon what they see happening in the economy. I don't think there are any political considerations at work here. And basically, I think that the markets have it sort of right in terms of expecting that over the next year or so, we may see another decline of roughly 75 basis points on average. If you think the economy is going to move in a weaker fashion, maybe they do more. But this is a Fed that will be watching things. And if the economy basically weakens, they will do more. If the economy stays in a situation where it doesn't need that decline in interest rates, they'll adjust accordingly.
Where are the risks that you're watching, and also, what are the real positives that you're watching that gives you confidence that we can escape a recession and that the economy will continue to grow?
Yeah, those are great questions, Consuelo. First of all, this is an economy that is like the Rodney Dangerfield of economies. It is very good, and yet it's not getting very much respect. I'm not quite sure why that is. This is an economy that has created 16 million new jobs. Corporate profits are at a record level. And look, I know that there are some problems. I know that middle income and lower middle income households have been feeling pressure. Obviously, their debt levels have been rising. But in recent months, we see that compensation increases are now dramatically outstripping inflation, which means that real household incomes are again rising. So this is an economy that is in pretty good shape, and that provides, I think, a very good anchor. The risks that I'm looking at are largely, if you will, political. Policy related as well. I mentioned deficit. We don't have to deal with that over the next few months, but at some point we will. I'm worried about the usual volatility we see around an election. I am concerned about the discussion we're already seeing about whether there will be good election integrity. Worried that the election season won't be over on November 5th or November 6th. We need to have a confidence in our nation that our elections are safe and secure. The people in charge, the various states' attorneys general, are telling us that they are, but there are political noises suggesting otherwise, and that's problematic to me. I'm also concerned about some of the policy suggestions that have been made. I'll just pick on one, and that has to do with tariffs. Now, both parties are talking about tariffs. The Democrats under President Biden got rid of some of the tariffs that had been imposed during the Trump administration on our allies. I mean, why we needed a tariff against Canada, saying there was a national security problem there, I don't quite understand. The tariffs that have been imposed under the Biden administration have basically been aimed at anti-dumping, making
China,
sure that
largely.
China
right,
primarily.
Right. Yeah.
Yeah. What I worry about are things that have been discussed on the other side, where we're going to have a blanket 10% tariff on everything. That doesn't make any sense because we will be harming not just those countries that some people consider to be our competitors and economic enemies, but also our economic friends. It's inflationary. Tariffs are inflationary, and they are not paid for by the other country. Ultimately, they are paid for by U.S. companies and U.S. consumers. So the tariff structure is just not a good idea from my standpoint.
As an investor, and putting on your old hat as an investment strategist, are there things that you should do knowing that these things could happen?
I would say one thing to be focused on is whether now is a good time or not to be invested in fixed income. One of the things to keep in mind is inflation is now coming under better control, but is that already reflected in yields? One question.
Your answer to that?
My answer is it depends upon where you are in the bond market. And so for most individual investors, a diversified portfolio of what's often called the total bond market is probably not a bad place to be because there's some yield pickup from money markets. I think that investors have to recognize that where we are now, there's going to be volatility in both bond prices and yields. It will not, however, be exceptional volatility as when we saw inflation go notably higher and then again notably lower.
Normally, if the Fed is easing, cutting interest rates, and the markets reflect that, normally that would be good for bond prices because when interest rates come down, bond prices go up. So are we in a situation like that, or is it already priced into the market?
I think a lot of that is already priced into the market. Not totally, but a great deal of it is. For investors who are based in various states and localities, there may be better opportunities, for example, in the municipal bond market. And some corporate bonds may also offer a better opportunity and higher yield than Treasury securities would.
And your second point, I think, was going to be about the equity markets, right?
It certainly would be. We have seen fabulous performance on the part of the S&P 500, but as your viewers already know, a good deal of that has been highly concentrated. Something like 7 companies represent the lion's share of the good performance in the S&P 500. At present, technology stocks are about 33% of the S&P 500. And one of the things I would encourage individual investors to be looking at now would be a diversified approach to the equity market. One way to do that is to look at some of the companies that haven't fared quite as well in the stock market. I think that the mid-cap stocks look quite interesting. If we look at PE ratios based upon the last 12 months of earnings, the S&P 500 is trading at about 27 or 28 times earnings. The mid-cap, about 17 times earnings. Price to book is also much lower. So I think you're getting a little more value there. You're also getting industrial diversification. S&P 500, as I mentioned, is about 1/3 technology. The mid-cap indices are about 10% technology.
And why not small cap? Why didn't you mention small cap?
There seems to be, let's just call it a higher survival rate among the mid-cap names than small cap. Also at this point, there's not much of a valuation differential between the small and the mid-cap. So I think you're getting a little more stability, less volatility in mid-cap than in the small cap arena.
If I were interviewing you when you were the chief investment strategist, the chief U.S. investment strategist at Goldman Sachs, I remember us thinking, this is a headline maker. Abby just said X about the market. What would the headline be from you about the market today?
I think the valuation of the S&P 500 market cap weighted index is somewhat challenging. We have seen terrific performance, but I do worry about that concentration. And it's not just the concentration in the index per se, it's also what we have seen in the underlying companies, where in the United States, so much of our CapEx has been focused on IT, both hardware and software, that there are some categories in the United States where we have been underinvesting as a nation. And I think that we need to move there, number one. Number two, with valuation at these levels, which is quite high, we can expect and have already started to see an increase in volatility. I think individual investors need to set what they think is appropriate for themselves as asset allocation and stick with it. And I think there could be some uncomfortable times short term. We're approaching an election, number one. Number two, seasonally. This part of the year is often uncomfortable. Why? Because we're running out of time. What does that mean? Well, if the consensus view, for example, of the earnings of company XYZ is a certain level, Well, that company is now running out of time to meet those earnings expectations. And so we often see an increase in volatility in the months of September, October, and particularly in an election year. So everybody tighten up your seatbelts.
As far as, again, individual investors, many individual investors have an S&P 500 index fund, for instance. And as you just said, a third of it is in these mega cap, the Magnificent Seven stocks. What's your advice for them?
Well, I will tell you that when I compare the valuation today versus the peak of the so-called TMT bubble in 2000, the valuations today are actually not as challenged as they were then, because these are solid companies with solid earnings. It's just that you're paying for those earnings. And so for those people who believe in technology, and I'm a technology believer, I just want to have other things in my portfolio in addition to that. Among the examples would be some cyclically sensitive names, which include, by the way, financials, and industrials. I also want some defensive names. I think that some of the food companies, some of the pharmaceutical companies, and some of the companies that work with consumers, like us, who are doing retail spending and so on. I think that these stocks are not unreasonably priced at these levels.
Any specific names that would represent this thesis, these theses?
I really think that for most individual investors, it's much better to go into a diversified portfolio rather than trying to do individual stock selection.
So your one investment for a long-term diversified portfolio, again, long-term diversified portfolio would be what?
Would be that mid-cap. If we're talking about a BlackRock ETF under the iShares mid-cap name, and there are comparable things that are provided by Vanguard and Franklin and Fidelity. These are diversified. They're very low cost. The mid-cap indices right now are offering yields of about 1.5%, which isn't as high as some other things, but it's nothing to sneeze at. And these are basically companies that are substantial, they're established, and they're likely to do okay in an economic environment that continues on. I'm not expecting a recession, nor am I expecting there to be an explosion in economic growth.
I'm hearing U.S. equities from you, which has actually been a long time and very lucrative theme since you first appeared on Wealth Track 20 years ago. So it sounds like, is the U.S. stock market still the best?
I am enthusiastic about the U.S. economy. We have the most productive workers on the planet. We do a lot of CapEx here. We have a nation that has done quite well, in fact, far better than any other economy post-pandemic. And so I am enthusiastic about the United States. However, if you ask me longer term, I think that the diversification should include not just some of those mid-cap areas that I mentioned, but I would be looking at international stocks at this point. And I would be looking, for example, again, if I just use the BlackRock as an example, but there are plenty of others out there, basically an MSCI EAFE index, which is the rest of the world. Why? Because it gives you diversification away from the United States. In the S&P 500, 1/3 of it is technology. In the EAFE index, because other countries are not as strong as we are in technology, it's about 10%. But you have higher weightings in things like pharmaceuticals, higher weightings in things like sophisticated applied industrials, and you also have some other consumer-related areas. Now, because of the valuation challenges, I think it's a great time to add diversification through the mid-cap names and also through some of the international names.
Abby Joseph Cohen, thank you so much. Such a treat to have you on Wealth Track again. And I know you're going to stick around because we're going to do another interview with you that's going to go much more global. And so, Abby, thanks for joining us this week to talk about the U.S. market.
Happy to do so.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is a classic one. It is don't fight the Fed. The phrase was coined by legendary investor Martin Zweig in his 1970 investment classic, Winning on Wall Street. In it, he wrote, "The monetary climate, primarily the trend in interest rates and Federal Reserve policy, is the dominant factor in determining the stock market's major direction." Well, some might quibble with monetary policy being the dominant factor, but it certainly is a dominant one. The Fed's recent decision to cut the federal funds rate, its key policy interest rate, by 50 basis points, represents a major change in Fed policy. According to Fed watcher Ed Yardeni, it marks the end of the Fed's monetary policy tightening cycle that started during March of 2022. Whatever the characterization, a 50 basis point cut is a big deal. The Fed is signaling that it intends to continue to lower rates at future policy meetings. And if history is any guide, a trend of lower rates will have a largely positive impact on the financial markets. Don't fight the Fed seems to be back in play. Next week, in part 2 of our interview with Abby Joseph Cohen, she will identify the global risks that have emerged over the last 20 years and what they mean for investors. In this week's extra feature, how is Joseph Cohen allocating her time since retiring from her demanding career at Goldman Sachs? Please follow us on Facebook, X, and our YouTube channel. Thank you so much for joining us this week. Have a revitalizing weekend and make the week ahead a healthy, profitable, and productive one.